Time to start again. Our goal is to be done by about 3 o'clock, I think was the agenda. 3:30. All right, come on. Our goal is to be done, midway through the afternoon. We tried running this all day one time, but we about lost everybody at 4 o'clock. We're just like tilting and falling in their chairs. So we smashed it together a little bit. The next up is Matt Ostanik. Matt is a serial entrepreneur. I'll let him tell you a little bit more of his background, but Matt's been a very successful entrepreneur here in Iowa. A lot of people know him here for his successes in his company, and as often is the case, we talk publicly about the successes, but there's always lessons learned that don't always get out there, and it's never as easy as the press can make it look, so-and-so raised this much money, yay! But I think it's important for you to maybe hear from somebody who's recently raised some money and kind of give you, and this is multiple times you've done this, a little bit of perspective. So with that, Matt.
Great, thanks, Mike. Well, it's nice to see the group today. I'm super excited by how many people are in the room, actually, so it's great to know that there's this much interest in raising capital, or folks that are in the middle of it, or thinking about it, or have other relationships with the process. So, a little bit of background on myself first. 14 years ago, I started a software company. It was called Submittal Exchange, and it was a software as a service company that provided online collaboration tools for commercial construction projects. So our clients were architects and contractors and facility owners. And I launched that while I was working full-time at an architectural firm locally, and I kind of worked on it as a side project for a couple years. And then 11 years ago, moved that into my full-time career and spent about 5 years building a business out of that. I really had no idea what I was doing when it came to running a software company or raising capital or anything else when I got started on that particular process. Ended up building a nice little company out of it in West Des Moines, and we sold it in 2011 to a Chicago-based construction software firm called Textura, and actually worked for them for a couple years, served on their executive team, and they invested a bunch more capital into my business here locally, and Textura went public in 2013, so I had a great chance to go basically over a 5 to 7 year journey from being like literally myself and one of their employees sitting in a room working on our product to being part of a publicly traded company that had thousands of customers and had some great growth that was going on. I chose to leave there at the end of 2013 then to start a new business, FunnelWise, which is my primary focus now today as well. And I want to share just some perspectives and some lessons learned from raising capital in both of those journeys. For my first business, for Submittal Exchange, I raised a small amount of money, probably less than $1 million total over multiple rounds, over multiple years, all from individual angel investors. And part of the challenge there was I had no credibility, I hadn't done it before, I frankly didn't really entirely know what I was doing either, and learned as I went along the way. And then with FunnelWise, I decided to take a bigger approach, and now that I've got some experience in the space, I've raised quite a bit more capital for that business to scale it more quickly also. And to give some more details on that, so we closed a Series A for FunnelWise in January of 2016, which actually doesn't feel like it was that long ago, but it's gone pretty quickly. And closed a $7 million Series A, so it was a pretty good size round. We actually had originally gone out to raise $4 million, and then we ended up with enough interest to do a larger amount than that and decided it would be smart to raise as much money as we could as long as the terms were attractive, which they were. And I've just got only 2 slides here of notes, but I'll talk through some of the things that I learned from that experience, and glad to answer questions that you guys have as well. So we kicked that off actually in July or August of the year before. So we closed in January of 16, probably like July of 15 was when we really went out to start on it. And I started tracking all the meetings and all the conversations I was having. And once we really got ramped up and going with it, I'm trying to think when the official kickoff was, probably early August. But basically over the course of 14 weeks, I had 112 meetings for pitches for people to participate in the capital raise. And it was not 112 different people, because some of those were multiple meetings. It usually took multiple meetings to get to a close with some individuals. But it was probably 70, 80, 90 different people total that I had meetings with as well. And after we had, basically it took 14 weeks to get verbal commitments to fill out the round. And then it took about another 2 months after that to work with our attorneys and an attorney representing some of the lead investors to work through all the terms on that and make some revisions to our documents. And so basically another 2 months to get through the legal work and to actually get the round closed. So then we closed it in January of 2016 and received the funds. And my strategy when going out for that round was pursuing two paths. I was going after individual investors, and I also was talking to VCs. And the challenge I had at that particular time was we had a product, we had customers of the product, but it was a very early stage. I mean, the product had been on the market for 6 to 9 months. We were selling at extreme discounts to bring on early stage customers. We had a very low revenue amount. Like we had revenue, but it was a very small amount of revenue. And we had the whole team put together, but still very, very early stage. And so I did a number of VC pitches and really found that I was getting a lot of resistance on just where revenue numbers were, which, basically a lot of comments have come back when you have $1 million in revenue, which is a reasonable response. But we ended up closing the round entirely from individual investors. And it was 26 individuals total that came on board to participate in that. So a few lessons learned from that process, 4 things that I would mention, or 4 quick stories that I would tell. So one is, I'm sure you've heard this already with other speakers today, it takes a ridiculous amount of work to raise money. It takes a ton of time, and it really takes all of your mental focus if you really are going about it seriously. And so I think my experience has been it's easier to do it in a focus period, right? Just to plan it's going to be your full-time focus, to jump into it, and to hopefully get it done and get it wrapped up as quickly as you can as well. But it is really a full-time job in and of itself. And that's very challenging, right? When you've got a startup or a small business and you're trying to run the business and also trying to raise money at the same time. You just have to be prepared to have the focus to put into raising capital. And ideally, you need a team or help, if you can get it, to kind of keep the other business activities going at least while you're focusing on capital raising as well. My second lesson learned, and this was particularly apparent to me going through those 112 meetings, was that all investing is local, or at least it requires a connection of some kind. And what I mean by that is, you can go out on sites like AngelList that Mike was talking about earlier and others and find, if you're an investor, as an angel investor, you can find thousands of things that you can invest in. And it's not that there's a lack of opportunities out there for investors. It's more finding the ones that resonate with them or that connect with them in particular. And part of what you have to try to do is find the connections with people. And what I mean by that is if you're based in Iowa and you're raising money in Iowa, that's a good thing because Iowans have an interest in investing in other things in Iowa. If you go outside of Iowa, it frankly can be very challenging. Not impossible, but it can be challenging depending on who you're talking to, because there is, some bias in some areas against what the tech scene in particular is like and what the startup scene is like in Iowa and how successful companies here can be. And frankly, I've had multiple people comment to me, particularly folks, in Silicon Valley, saying, well, they've got thousands and thousands of opportunities to invest out there. Why would they go to someplace in Iowa and put their money into an Iowa company, for example? And the answer is they oftentimes don't unless there's some particular connection that you have. And that connection could be a story that you have about the problem you're trying to solve that resonates with that particular person or that particular investor. Or it could be some other mutual connection, people you know, or I'll give you an example. In my case, one of our largest individual investors that came on is actually based in New York. And I got introduced to him. I'll tell that story in a second, actually. But I got introduced to him, and it turns out he really likes investing in Iowa. He's actually done multiple investments in other Iowa companies in the past, I'm not sure, 5, 10, 15 years, and is very active in New York and other places as well. But he had a history and some other successes in working with Iowans. And so that ended up being a great mutual connection that even though he wasn't from Iowa, he had experience here, which was helpful. So as you go out and really think about how you're going to identify folks, I think you have to look first for geographic connections. It's always easier to raise locally if you can. But beyond that, you have to look for people that would have an interest in what you're doing. So whatever problem you're trying to solve, whatever the mission is that you're taking on, how can you find people that story would resonate with as well? The third point, this was actually, I probably knew this going into it, but this was really eye-opening for me to actually experience this firsthand. So I've got 26 investors. And of those 26, 3 people are at $1 million plus, and everybody else is less than that. Our minimum for our round was $50,000. I ended up making a couple exceptions to the minimum. honestly, for people that were related to some of my employees, because my theory was I'd like my employees to have their relatives invested in the company, because I know this from my own experience from raising money from my father and brother-in-law in the past as well. Like, it's one thing when you're betting your own money, it's another thing when you've got relatives with money in, and you know you're gonna have to sit across from them at Thanksgiving or Christmas every year for years to come and get asked about how the business is doing. Like, you don't want to lose their money, right? So I figured it'd be highly motivating for employees of mine to be able to have the chance for some of their relatives to participate, going after people that are putting in $20,000 at a time, or I could spend the same amount of time going after putting in people that put in $1 million or more at a time. So it's kind of a question of the best use of your time. Now, obviously, there's the question of how many people do you know that can write $1 million plus checks? And the answer is I don't know that many that can, and I imagine most people don't either. So there's the limitations on the pool, but certainly to the extent that you can focus on folks that can write larger checks, whatever those checks are relative to your round, it can be a much easier process for managing the time commitment for it if you can find those people as well. And then my last particular lesson learned that I would share with this group is really think about it in terms of the long-term game of where you're going to go with your business over the next 5 or 10 years or beyond, anything that you might do beyond that as well. And in my experience, some of the best investors can be people that turn you down the first time around as well. It's very important to not burn bridges, and it's very important to keep those relationships open. And sometimes the timing might not be right for them, or they may not be interested in what you're doing the first time around, but you might come back to them in a couple years when you're raising again and find that it is a good fit at that time. Or you might do something else further down the road and you might come back to them and find that it is a good fit at that time. So one of the investors in FunnelWise today was actually a gentleman who I had pitched on my previous company on Submittal Exchange years before. And I distinctly remember it because I really remember everybody that turned me down that first time around, and he very vocally turned me down with Submittal Exchange. In particular, he turned me down because he told me my valuation was crazy for Submittal Exchange at the time. And this, when was that? 2008-ish, probably. But we had a specific conversation about how crazy my valuation was for Submittal Exchange. And I remember it because I went back and forth with him and gave him all the logical explanation about why I know it was a great valuation, and he still told me no way. And it turns out in hindsight, if he had come in at that valuation, he probably would have made like an 8 times return on his money. Which now, some of that is how circumstances turned out, and that may or may not be repeatable in the future, right? But it did turn out really well, and he missed out. And the cool thing was he recognized that he missed out on it later, because when I went around to raise money for FunnelWise, I had somebody that encouraged me to pitch this person again, and my initial reaction was, no, I've talked to him in the past, I don't need to go to him again. But I decided to go talk to him again, and he remembered our previous conversation specifically before, and he remembered it in the context of, I probably should have invested that first time around. So he was an excited, enthusiastic investor in FunnelWise this time around. And more importantly, he introduced me to several key people. And through the introductions he offered, one of those people, actually 2 of them, ended up being $1 million plus investors in FunnelWise this time around as well. So from that connection from someone that I had known years before, that had turned me down in the past, but who I'd gone back to again, and he'd seen how things had played out, at a future date, it ended up being a great connection. And he's fantastic to work with, and I'm very fortunate to have him on my cap table now today as well. But it's funny how those stories work out, but it was definitely a great lesson for me of, when you're out there raising money and you just need to raise the money and someone turns you down, it's tough because it is emotional, right? It's your baby and you know how great your company is going to be. And frankly, it's frustrating when people turn you down, but the reality is you're going to get turned down way more times than you're going to get people that invest. And you should still stay in touch with those people that turned you down, and you never know what's going to come from those relationships in the future as well. So definitely think about the long-term game with it. Awesome. So those were probably the 4 key things that I would say. And I'd be glad to answer any questions on our experience. I could talk about this stuff for an hour, but you guys have plenty of other experts that are going to tell you everything that you need to know here today as well. So if there's any other specific questions I can answer just from my own experience with doing a relatively recent raise, I'd be glad to. Go ahead.
The fact that all of your investors both times were kind of individual investors, right?
Yeah.
Do you feel like that's your sweet spot for presenting, or is that a product of the product that you're putting out there? Is it valuable to know where your sweet spot is from an investor standpoint, from that standpoint, from your style or how you relate to people? It's just interesting.
Yeah, it is interesting.
For that trend.
I guess, I mean, I would like to think those have been the sweet spots for the companies and where they're at, but you're right, probably part of it is a reflection on me as well. With the first time around, my first company, it was a small company, it was early stage, I had no track record. My realistically chance of raising from larger VCs in the space that I was in was probably low, based on my own experience and where the company was at. The second time around with FunnelWise, got the track record, but the company was so early stage that running into objections over where our revenue is very reasonable. Now, part of the challenge too is the space that we're in, and really a lot of out-of-state VCs are going to be looking for home runs, right? I mean, they need to, even though most of their investments are going to fail, to generate the types of returns they need for their investors in their funds. They need to know that every single company that they're putting money into could be a $1 billion exit, right? And I think with what we were doing with FunnelWise is a fantastic business. It is growing great. It's going to be phenomenally successful. Are you going to see it going public on the New York Stock Exchange someday? Probably not. It's probably not that level of opportunity. And so it wasn't, that company, both it was too early and it wasn't scaled big enough to really attract more of the out-of-state VC dollars. So it's probably more of a sweet spot for the company and what you're trying to do. And some of it's, what sort of returns those investors look for. Like I pitched a VC fund in Chicago that actually really focuses on early stage stuff and is a great fund, but I had already put a fair amount of money into the business before I raised that round. Like I did the seed funding myself, and because of that our valuation was a bit higher, and I still remember the feedback from that fund was, we actually think you're at the right spot for us to invest in, but we need to see a clear path to a 25x return on this. If you can't show us how we're going to get 25x, then we're not interested. And the reality is I couldn't show that path based on where our valuation was as well. So that's a long answer, but I think it's partially a sweet spot for the individual, but it's more a sweet spot for where the company is at and what you're able to offer investors.
Thank you.
Yeah, go ahead.
So of the 26, when you said you have 26 investors, can you give us a sense of the sort of geographic distribution that ended up putting together?
Yeah, over half of them are in Iowa. Most of the rest that are not in Iowa are people that I know personally, or my employees know, so they're related to me or related to one of my employees. And then a couple of the non-Iowa ones are introductions from other people in Iowa as well. So, it really comes down to those personal connections. My philosophy on raising capital, particularly if you're going after individuals, is you should just ask every single person you know. Like literally every person you can think of that would have any interest, right? And you shouldn't be shy about it, and you should just expect that the vast majority are going to say no. But every person that does agree to talk to you, you should ask them for introductions and see if they can give you 1 or 2 introductions to other people. And that's how you get out there and network, right? And half the people will say they'll give you some introductions, and of those that say they will, probably half will actually follow up and do it. But if you keep chasing those introductions, you can get, it's pretty easy to get to 50 or 100 plus people if you make it your full-time focus and just constantly work through your network and constantly ask people for it, if that makes sense.
Yeah. You said early on you had to discount your revenue or discount your price to get some customer traction.
Yeah.
Was that discounted by the investors? Did they look at that and say, that's not a true value assumption if you're having to cut the price to get to them? Did they question that at all?
Not with the audience that I was working with, or investors. I think pricing is a whole nother complicated topic. Glad we talk about that one more offline as well. But I think it's reasonable in early stage stuff that your pricing is going to evolve as well. So, really, when you're less than $1 million in revenue, in my opinion, or even less than a couple $1 million, your valuation and what you're raising money on is not based on where your revenue is at. It's based on the potential of where you're going in the future, if that makes sense. Mm-hmm. Now, a company that has revenue is always better to invest in than one that has zero, because you've proven you can sell something, but still the valuation metrics and depending on the investors you're working with aren't going to be tied to the specific dollar amounts as much, in my opinion, of what you're selling for. Does that make sense?
Yeah.
Cool. Go ahead.
So you closed your fund about a year ago now, your $7 million fund. Just getting an idea, I guess. Are you looking to raise money again then in another 12 months, 9 months? It's been about 12 months now. I think earlier, 15 to 18 months was the average, raise. I think it was like that. I think you said that, Charisse?
Yeah, typically a timeline.
Yeah, timeline. So I was kind of, curious what your thoughts are on the next stage. Are you looking at it already yet? Just kind of what you're gonna do next time around.
Yeah, I think the 12 to 18 months is always what I've followed too, and I think 18 months is a good good benchmark, right? 12 months to make some progress, and then 6 more months to do another raise. So, when I did this round, there was a scenario where we may not raise capital. Again, if we can get to the business to a certain point. The reality is everything takes longer and costs more than we think it will, right? Like I've learned that lesson about 1,000 times in a row in the past 10 years. It's always the case. And in the space that we're in, we've also realized that we actually don't have a lot of direct competitors, but we do have a lot of other complementary things that are going after the same target audience as us, and all of those companies are raising way more money than we are. Doesn't mean we have to raise that much, but we do need to spend some more. So the short answer is, yeah, we will raise more in the future. I mean, the nice thing is you want to have as much control over that as possible. You want to see it coming. You don't want to be surprised by it. You want to set expectations with your investors, and you don't ever want to be in a situation where like you're up some deadline and you've got 30 days left and you have to raise capital or you can't meet payroll, because then you don't dictate the terms and the investors do. You always want to be further ahead than that. So I think I'm officially over my time limit, but Casey, I'll answer your question and then I'm done here. Go ahead.
When you were making the decision, you said in this last round, you kind of set out to raise 4, you ended up raising 7.
Yeah.
Right? Pretty big difference there.
It is, yeah.
When you were sort of thinking through the amount to raise, what was the deciding factor to kind of go for more versus stay where you're at? Was it just the thought that you learned that it was probably going to take more, or?
Yes, I mean, it really was. We had people that were interested, and we actually worked out some terms where we didn't receive all 7 up front. We received part of it, and then the rest of it was going to be priced based on the company's growth. So it allowed us a convenient way to structure it, to have the commitments, but to structure it in a way that still allowed us flexibility as the company grew from a valuation standpoint. And it's just, I mean, great entrepreneurial lesson, definitely in the top 3, right? It always costs more than you think it will. So if you have the option to take more money, you probably should. It just always takes more than you think it will as well. So if the terms are good, that's really what it came down to in that situation.
And then the company you sold before, didn't the holding company also get acquired by, was it Ortho?
Yeah, no, that's a good point. Yeah, so the company that bought mine went public, had a great IPO, stock price like almost tripled, and then went on a roller coaster ride after that, and eventually got acquired for a much lower price by Oracle. So my previous company is part of Oracle now. So appreciate your time today. Good luck with the rest of